If you think silver has one price, I want you to pause for a second, because the most dangerous moments in any market start exactly like this. The screen looks normal, the headlines look manageable, and then real-world buying quietly stops matching the official quote. One day you can buy silver everywhere at a tight premium, and the next day dealers hesitate, spreads widen, and suddenly the only thing that feels real is the higher price you're forced to pay to actually get metal. That is what a system break moment looks like in real time. And if it keeps accelerating, price discovery doesn't start with fireworks on TV. It starts with premiums and availability behaving like the paper price doesn't matter anymore. If you like simple story-style breakdowns that cut through the noise, please hit like and subscribe right now. It takes 1 second, and it helps this video reach more people who are trying to understand what's happening before the mainstream even notices. I'll keep the language clear, the flow smooth, and I'll tell you exactly what to watch this week, so you can judge the situation for yourself. And just a quick note, this is educational, not financial advice. Now let's talk about what paper silver versus physical silver really means, because it's one of those phrases people throw around without explaining it. Paper silver is the world of contracts, claims, and instant liquidity, where massive volume can trade without a single bar moving. Physical silver is the real-world supply chain, mined, refined, minted, shipped, insured, stored, and delivered. Most of the time, those two worlds stay close enough that everyone treats them as one market. But when stress builds, they separate, and the separation shows up first as premiums, delays, and no-quote behavior. Here's the cleanest way to imagine it. Think of paper silver like a digital boarding pass, and physical silver like an actual seat on the plane. In normal times, nobody questions the boarding pass because there are plenty of seats. In stress times, the boarding pass still looks valid on your phone, but suddenly you hear, "We're overbooked," and the system tries to solve the problem with vouchers, rebooking, or cash compensation. That's not a perfect analogy, but it captures the feeling. Paper can keep printing a price, while physical starts acting like the real resource is tighter than people assumed. And this is why the phrase, "price discovery begins," matters. Price discovery is supposed to be the market honestly revealing what something costs when real buyers meet real sellers. If physical demand stays strong while the paper market keeps quoting a comfortable price, the physical market will eventually force the issue. It does that by refusing to clear at the paper price. Not through speeches, not through conspiracy theories, but through simple behavior. Higher premiums, less availability, longer delivery times, and wholesalers demanding better terms. So what does a system break moment actually look like in silver? It looks like the same metal behaving like two different products. Spot price might dip, but physical premiums don't follow it down. Or spot price might be flat, but suddenly retail prices rise anyway because supply is tight. It looks like certain products disappearing first, like popular coins or smaller bars, while the headline price doesn't fully reflect that stress. It looks like the real, lived price of silver drifting away from the official price. If you're in the US, you've probably experienced a version of this already. You see a spot quote and think you understand the cost, then you try to buy, and the checkout total tells a different story. That difference is the premium, and in calm markets, it's boring. But in tight markets, premiums become the truth teller. Premiums are where physical reality leaks into a paper-driven system. Now, people will immediately ask, if physical is higher, why doesn't arbitrage fix it? Because in real life, that arbitrage isn't frictionless. Silver is heavy, slow, and rules-based. It has to be the right form, the right purity, the right brand or bar standard. And it has to move through approved channels with financing and insurance. Shipping costs, refining capacity, paperwork, taxes, and timing risk are not small details. They're the reason gaps can persist. And when markets get stressed, those frictions get worse, not better. This is also why the Shanghai price matters so much in this story. When silver trades higher in Shanghai than in Western hubs, it can signal that real metal is being bid up where physical demand is immediate. That doesn't guarantee a global spike tomorrow, but it does tell you something important. There's a place on Earth where buyers are willing to pay more right now for access. If that higher bid persists, it acts like a magnet. Over time, metal tends to flow toward the highest effective price, and that can quietly drain availability elsewhere. Now blend that with industrial demand, and this gets more interesting. Silver is not only an investment metal, it's also an industrial input used in electronics, soldering, medical applications, and especially solar supply chains. Industrial buyers don't purchase because a chart looks bullish. They purchase because production needs the input, and production deadlines don't care about market convenience. When industrial demand is steady and supply isn't flexible, physical tightness can stay stubborn even if paper traders try to fade every rally. So where does the paper price come from, and why can it stay disconnected? Paper pricing is heavily influenced by futures markets, which are built for liquidity and hedging. Futures allow huge amounts of exposure to trade without immediate delivery of metal. That structure is normal in commodities, but it creates a strange situation. Paper supply can look endless because contracts can be created instantly. Physical supply cannot scale instantly because mining, refining, and shipping take time. When enough participants start wanting physical certainty instead of paper exposure, the system feels it. And the system often feels it first through near-term urgency. In plain English, the market starts valuing silver now more than silver later. When that happens, the relationship between the front month contract and later months can change in a way that hints at tightness. You don't need to become a futures expert to understand the message. If the market starts paying up for immediate availability, it's telling you something about present conditions, not just future expectations. Another place the story shows up is in vault behavior and inventories. You'll hear people mention COMEX, LBMA, registered categories, eligible categories, and a lot of terms that sound confusing. Keep it simple. Inventories and deliverable stock levels matter because they represent the cushion in the system. Inventory can move for many reasons, so this isn't about hype. But if inventory trends down persistently while physical demand remains firm, the cushion gets thinner. And when the cushion gets thinner, the physical market has less ability to absorb buying without demanding a higher effective price. There's also a plumbing signal people rarely watch: borrowing tightness, sometimes discussed as lease rates. Here's the simple idea. When something is abundant, borrowing it is easy and cheap. When something is scarce or hard to locate, borrowing can become more expensive and more complicated. You don't need to track every metric to understand the direction. If physical tightness is real, borrowing conditions often reflect it sooner or later. Now let's talk about why system break moments feel sudden even when the pressure built slowly. Markets don't move like a smooth elevator. They move like a crowded room where everyone tries to exit through the same door when they finally notice smoke. Physical tightness can build quietly for weeks, showing up as premiums that refuse to fall and supply that refills slower than normal. Then one day, a catalyst hits, a macro surprise, a currency move, a shift in risk sentiment, or a technical breakout. And in that moment, paper traders and algorithmic systems react together, which can accelerate the move. Options can make that acceleration sharper. When silver approaches major strike levels, market makers hedge exposure, and hedging can create forced buying during fast moves. That buying pushes price higher, which triggers more hedging, which pushes price again. It's a feedback loop. You don't have to trade options to feel the effect. You just need to recognize that certain levels can act like ignition points when the market is already tense. ETFs and fund flows add another layer. When investor demand surges into big silver vehicles, that flow can influence wholesale demand depending on how the mechanism works and what metal is needed for creations and redemptions. Even when the details are complex, the outcome can be simple. Strong inflows during a tight physical environment can make sourcing metal harder. And when sourcing metal gets harder, premiums and spreads tend to widen because the real-world pipeline is strained. This is where people start using dramatic words like break, and I want to keep this grounded. A system break doesn't always look like a single, obvious event. Often, it looks like separation. Paper continues quoting a price, but physical becomes a product that trades on different terms. Dealers widen spreads, certain items go on back order, wholesale bars get tighter, and buyers slowly realize the price I see isn't the price I can reliably transact at. And when that separation grows, price discovery begins in the physical market first. It begins where real demand meets real supply constraints. It begins in premiums, in availability, and in the willingness of sellers to part with metal. That is why, during stressed periods, you can see the paper price hesitate while physical costs climb anyway. Physical doesn't need permission from the screen. It just needs buyers who keep showing up. So what should you watch right now to know whether this is a normal premium cycle or a true split accelerating? Watch what happens when spot pulls back. If physical premiums and availability improve quickly, the system is relieving pressure. If spot pulls back and physical stays tight anyway, that's when the split looks more structural. Watch whether dealers suddenly stop discounting and start protecting inventory. Watch whether delivery times stretch instead of shrink. Also watch whether the higher price elsewhere story persists, especially if Shanghai remains elevated relative to Western quotes for multiple sessions. A one-day gap can be noise. A persistent gap is pressure. And if that pressure coincides with stubborn US premiums, you have two different physical markets telling a similar story. Metal is more valuable in hand than it looks on a screen. Now I want to address a fear that comes up in comments every time. Does this mean the paper market is about to collapse? Not necessarily, and I'm not here to sell panic. Paper markets have tools to manage stress, including widening spreads, raising margin requirements, and encouraging cash settlement behavior. Those tools can reduce the immediate delivery strain. But here's the catch. Those tools can also increase the feeling of separation because they keep paper trading smoothly while physical becomes more expensive or less accessible. In other words, The system can remain functional while the public loses trust in the reference price as a reflection of real availability. That's why I call this a system break moment, not because everything ends tomorrow, but because the relationships are what matter. When a market that RS, supposed to be globally connected, starts showing persistent gaps and stubborn physical premiums, it's telling you the pipeline is stressed. It's telling you the clearing mechanism is changing. And once a market starts changing its clearing mechanism, repricing can happen faster than people expect. Here's a calm way to think about it. In normal times, spot is the main signal and premiums are the small footnote. In stressed times, premiums become the signal and spot becomes the headline. When that flip happens, it changes how people behave. Some people stop trusting paper pricing and move toward physical. Some people accept substitutes. Some people step back and wait. Those behavior shifts are exactly how price discovery gets forced. And there's another reason this can accelerate: confidence. Markets run on confidence that contracts can be settled smoothly under expected terms. When enough participants start asking, can I actually get metal when I want it? The demand for certainty rises. That certainty often has a price. That price shows up as premiums. Over time, if enough buyers are willing to pay that certainty price, the reference price tends to follow, even if it resists at first. So what does price discovery begins really mean for the average person watching from the US? It means stop thinking of silver as one number. Start thinking in layers. Paper quote, wholesale availability, retail premiums, and delivery terms. It means noticing whether the market is clearing through price or through rationing. Because when markets can't clear smoothly through price, they often clear through rationing, limited stock, higher spreads, slower delivery, and selective quoting. Now, none of this means you should rush into decisions. Silver is volatile, and emotional decisions are expensive. But understanding the structure helps you stay calm. It helps you interpret what you're seeing without feeling confused. If you see premiums exploding while spot looks sleepy, you're not watching nothing. You're watching the physical market send a message in the only language it has. And this is the final point I want you to keep in your pocket, because it's the simplest tell of a real split. If physical stays tight, even when paper price gives you reasons it should loosen, that's when the paper market is losing control of the narrative. It doesn't mean a dramatic headline must happen tomorrow. It means the system is under pressure, and pressure eventually resolves either through a release valve that restores flow or through repricing that acknowledges scarcity. Now I want to hear from you because your real-world experience is part of the data. In the comments, tell me what you're seeing where you live in the US. Are physical premiums coming down, staying stubborn, or getting worse? Are your local dealers well stocked, or are certain products hard to find? And if you've noticed a gap between paper price and what you can actually buy, describe it in a sentence so everyone can compare notes. If this video helped you understand what system break moment really looks like, please share it with one friend who still believes silver has one simple price. Sharing helps more than you think, because it brings people into the conversation before the headlines get dramatic. And if you want to follow up where I break down the exact weekly signals to watch, premiums, spreads, inventory trends, and how to interpret them when spot is rising versus falling, tell me in the comments, and I'll make that next.